The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So welcome back. It is Thursday, Friday, or Saturday, depending upon the day that you're listening to us, and we're going to be talking about money. One thing that came to mind as I was thinking about putting the program together this week is the discovery of America. You know, in 1492, Christopher Columbus discovered America. But we don't call this continent Columbia. It actually has a lot to do with a forger. And it has to do with trade. So all that's coming in the latter part of the program. I've got lots to say about that. I've got a really great guest you want to hear today. But I wanted to start talking about debt limits, the tax bill, all those things pulled together. And I think the place to really begin is with John Maynard Keynes. Keynes was an economist that lived from 1883 to 1946. Time magazine said he was one of the 100 most influential people of the 20th century. He was a British economist and what they call maybe their most influential British economist. And it was during the Great Depression that he set off a revolution in economic thinking. He said it was aggregate demand that determined overall economic activity. Aggregate demand. It was demand. You know, thinking about economics courses you took where you had supply and demand and those curves, and if supply went up, prices went down. He said it was aggregate demand that determined overall economic activity. And it was fiscal and monetary policy that could mitigate the impact of recessions. When Time magazine picked him as one of the most influential people of the 20th century, they said this. They said the radical idea that governments should spend money they don't have may have actually saved capitalism. We're going to come back to John Maynard Keynes because it has something to do with the tax bill that we're passing. But I first want to talk about debt because on Facebook, and you can find us on Facebook about money, on Facebook, somebody made the comment, a fairly significant person made a comment that he really didn't like debt. It said that the Democrats want to tax and spend, the Republicans want to borrow and spend, but someday the debt will fall on our children or our grandchildren. But there's a real difference between you and I and countries. You and I someday will actually die, and our debts have to be paid off. Debt has a maturity, and at that time, it has to be paid. For us, for individuals, we have to pay that debt off, and we can't consistently renew because at some time our lives are terminal. But countries don't have a terminal time. Countries like France and England continue for centuries. They've had debt for over 1,000 years. They continue to roll over their debt. Every time it comes due, they can borrow more. And they continue that again and again. That's how countries operate. You know, it depends upon GDP. There's a, illustrating that, for an individual, the more your income, the more you can usually borrow. It's the same with countries. It relates to GDP. The greater the economic power of the country, the greater their real borrowing can be. So the argument that our children and grandchildren are going to inherit the debt, yes, they will. The argument, however, that they're going to have to pay off the debt, that's not necessarily true. It's not necessarily true that our great-grandchildren will, or our great-great-grandchildren, or our great-great-great-grandchildren will. When you really think about it, you and I have inherited some debt that goes back to the 1840s. This country has had debt since the 1840s, and they passed it from generation to generation to generation to generation. So that's now, as a country, we've had debt for 170 years. So, this whole comment that the Democrats want to tax and spend and the Republicans want to borrow and spend, that's true. And I think that's where the debt limit really comes into play. The person that made the comment about not liking the debt, it was going to have to be paid off after I made that comment and rebuttal on Facebook, he says, I have to agree with you, but then there's the debt limit. I don't like the debt limit because it becomes a very political thing. It becomes very awkward. It causes a lot of ups and downs and the potential for disagreements, for arguments, and potentially a default on the debt. He didn't like it. But I disagreed with that comment as well. I disagree because when you look at it, his original comment that the Democrats want to tax and spend and Republicans now want to borrow and spend, which incidentally is different from the Republican Party that I knew only a few years ago that didn't want to borrow and spend. They wanted to pay down the debt. But in any case, with the new tax bill, they're talking about borrowing and spending. I like the debt limit. There was a time in the 50s and 60s when the country was really growing. Government revenues were coming in and growing significantly and covering almost all the needs. But those times have changed now. There are actually more demands on government than the revenues can cover. And no, the government's not efficient. I agree with that. The government could do a lot more to improve their efficiency. But when you think about it, the government allocates funds, and it's our Congress. Our Congress are a group of generalists. Our president generally is a generalist. They're people who take the information from different bill sponsors and put it into effect. They're not economists. They're not accountants. They're not foreign policy. They're not healthcare experts. They're not experts in many fields. They're generalists. And so when it comes time to setting a budget, they set large guidelines. But we're at the point now where there's a lot of demand, more demand than we have revenues. And so what I like about the debt limit is it forces our Congress and our president to think about prioritizing what needs to be spent. And sometimes you may agree with the priorities and sometimes disagree, but at least there's a prioritization. And I think of California, balancing the budget does essentially the same thing. You have revenues coming in, you forecast what the revenues are, and then you have to cut spending or increase spending to balance the budget. But when you look at California, California has been a state that's grown very, very strongly. The revenues have grown very strongly. But what they do with a balanced budget, and you can see it very clearly, when things are really good and they look like they're going to continue and things are going to be really great, California tends to commit to big multi-year spending. So they're locked in. They're into this multi-year. And then when the recession hits, then when bad times hits, to meet a balanced budget, they have to trim programs. Oftentimes, those are social programs, the programs which you prefer not to cut, but because during the good times, they made all those great commitments. That is where they cut the social programs. It's just the opposite of what our government does. Think about it. When the tough times hit with the government, we fall back to John Maynard Keynes, and the government spends money it doesn't have. It borrows the money. It spends money it doesn't have to stimulate the economy. So during the good times, there should be times in which we cut back on spending, During the bad times, it means that we borrow money to spend. It's a way in which the government operates more efficiently than with a balanced budget. But coming back to John Maynard Keynes, coming back to how all this applies to the tax bill that passed the House today. So it really makes a number of reforms, but the big focus has been on the tax rates and tax cuts. And for that, the Art Laffer was on the Economic Policy Advisory Board to Ronald Reagan, served there from 1981 to 1989. And he became known for what's known as the Laffer Curve. That's not laughter, it's Laffer, named after Laffer. And it's a curve that he drew on a napkin to explain to Ronald Reagan the impact of taxes and the economy. It's important to understand that with what's going on in Washington, because it will have an impact on the market. And we're going to get to that right after the commercial break. We are coming up to a commercial break. And so don't go away. We've got a lot more to cover in terms of the debt limit, tax reform, the stock market. Got a great guest coming, and we want to find out about trade. We'll come back to all that. Don't go away. Right after the break.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
I don't know if you were listening to the ad that just ran, 5 ways they make money. I've always thought the way you make money is to buy low and sell high. Now, could be completely wrong, but I don't know that there's 5 different ways to make money. It's buying low, selling high. Whether it's real estate, whether it's stocks, whatever it is, gold, paintings, wine. I think the way you make money is to buy low, sell high. But anyway, sorry, that just caught my attention as they were doing the commercial. I want to come back. I've been talking about debt. I've been talking about the debt limit. But I want to talk about tax reform. The House passed out the tax bill. It'll go to the Senate now. The Senate's making some changes. But I think the impact, to understand the real impact, you have to go back and look at the economics. And Art Laffer was on the Economic Policy Advisory Board for Ronald Reagan. And on Reagan, I think he drew on the back of a napkin, he drew what's now become known as the Laffer Curve to explain in a fairly simple way, an understandable way, what happens with tax rates and revenue coming into the government. If revenue coming into the government increases, you have less of a deficit, less borrowing. If you have less revenue coming into the government and the same amount of spending, you have to borrow more money. That's pretty straightforward. I think that's stating the obvious. It's like the basketball game where the person that says if you can hold the other team under 100 points and your team scores over 100 points, you usually win. I think the Laffer Curve is a simple way so you can understand. And basically what it was is an upside down U. So you have a U that starts at a 0 and goes to 100, the up and down. Along the horizontal axis, the one that's flat, are the tax rates, going from 0% tax rate to 100%. And going up the vertical axis, you have government revenues, whatever they are. It's a relative term to what they are today. So if you start at 0, if the government has 0 taxes, they're going to get 0 revenues. I think that's pretty straightforward. If you tax 100%, nobody's going to work because they don't take any money. So at both points, you're at 0 on the horizontal axis, and you get the upside down U then. As money comes into the government and as tax rates move up, if you go from 0 to 10%, revenues are going up. You're going up the left side of the U, up the left side. If you think of the upside down U, the left side is going to be up and the right side is going to be down. If you go from 100 to 90%, there'll be a few people working, so you'll actually have revenues coming in at 90%. So the question is, what does all that have to do? Well, if you change the tax rates, you're going to move on that curve. If you lower taxes and you're on the left side of the curve, if you lower taxes and you're on the left side of the curve, think about it. You move down, and that's the curve that's going up to the top of the U. So if you lower taxes, you're moving to the left side, revenues are going down. On the other hand, if you're on the right side of the curve, where you're at the top of the U and you're coming back down to 0, if you now lower taxes, revenues actually go up. They go up. So if you look at what happened when John Kennedy was president, he was one of the first, maybe the very first, to implement what Keynes said in terms of government. He cut taxes in his almost first year, either the first or the beginning of his second year. He cut taxes, and all it really meant was essentially $100 per person. But what it did is it cut the deficit fairly significantly because he was on the right side of the curve. When the tax rate went down, revenues to the government actually went up. If you look at the Clinton administration, they were on the left side of the curve. They raised taxes and revenues went up. So it depends upon where you are on the curve. If you look at the George W. Bush years, they cut taxes, revenues went down. They were on the left side of the curve. So it depends upon where you are on the curve. It's a question of when you're giving a tax cut, what happens to that money? And it's back to the butcher pays the baker pays the candlestick maker. For example, back when we talked about $100 per person in the Kennedy time, you take the $100, if you're at one of the workers who gets $100 back, you go out and spend it at a restaurant, for example, go to dinner, spend $100, leave it a $20 tip. So $20, or of the $100, $20 is a tip. $20 goes to the wait staff, $80 to the owner of the restaurant. Of the $80, 75 cents goes to a food vendor, which is an income to the food vendor. And maybe the farmer gets $50 and $25 goes to the employees and the owners, 5% profit. Anyway, you get the picture. There's a multiplier effect. It's not just a $100 per person. By the time it goes through the butcher, the baker, and the candlestick maker, you have 2.5 to 4 times over. Those are the people that spend it. Now, the issue with the current tax bill is it's a reduction to large corporations and some small, but not all small businesses. For example, to the financial services, it's not going to be a tax cut for what I do. It's going to actually be a tax increase, or tax neutral. So the taxes are going to go to large companies, and it becomes then a difference between that going to the butcher, baker, and candlestick maker as opposed to going to increase wealth. And we'll come back to that in a second. The reduction is going to be, the reduction in taxes is primarily to the higher income people, with a burden on the lower income people. I think that's going to be a negative for the economy, but a positive for wealth. The high income people are going to invest in the stock market. They're going to make investments. But when you're investing in the stock market, that money is not going to companies to grow their business. It's driving up the market. That's not an economic positive force. That's just a very nice thing for the stock market, which isn't bad for my clients because they gain wealth. But it doesn't have the impact that they're hoping it's going to have. It's not going to create additional jobs. It will create some, but not the same as if that money went to the very lowest income people. If it goes to the bottom income people, they tend to spend all that money, and you get a much bigger multiplier. The $100 gets spent on clothing, it gets spent on cars, it gets spent. And when it gets spent, it goes from the butcher to the baker to the candlestick maker. When it goes to the top, it ends up going into increasing the prices of things rather than economic stimulation. That's my take on where it is. I don't think that that's very clear. And I'm still concerned that we're on the left side of the curve, that when we cut the tax rates, it's not going to stimulate business. It's going to be more a drag on the economy, just as it was during the George W. Bush years. I could be completely wrong. It could be the most wonderful thing that ever happened. But I'm not planning on that. I'm planning for my clients that it's not an economic stimulus, that instead it tends to increase wealth, increase inflation, and will play that way. Knowing that it could be an economic stimulus, if it's a stimulus, it's a long-term effect. If it's just a non-economic stimulus, but an increase in values, we'll take it either way, but we'll be very aware that there's a long-term penalty to pay. Anyway, that wraps that up. I want to introduce my guest because he's got a very interesting story to tell. Ezra Fain, did I say it correctly?
That's correct.
From Bridge Partners. So welcome to the program, Ezra.
Hey, great to be here. Thank you very much. I've been looking forward to being on your show for a while now. So again, my name's Ezra Fain. I work with Bridge Partners. We're a business consulting firm. So what we do is we help Fortune 50 companies, help them realize their goals and transform into a more competitive business and grow enterprise value for these firms. We do this in what we call practice areas. So
before we get there,
Sure.
Let's start with your background.
Sure.
So that people get an idea of who you are.
Sure. So I have a background in mechanical engineering. I used to work in the aerospace and the manufacturing industry. I went back to the University of Washington and got my master's in business administration. And I've been in consulting now for over 10 years.
And you have a consulting firm which has offices located.
So our headquarters is here in Seattle. We have about 250 folks here in Seattle. We also have offices in the Bay Area, in Chicago, in Austin, and in Dallas.
So it's not just a one-man operation. It's significant.
Now, we've got a great team.
And we're going to get to that right after the commercial break. We are coming to a commercial break. We'll talk about what Bridge Partners does and what they do, why you should be talking to them if you fall within their category. If you miss any part of this program or any part of other programs, you can find them on YouTube. You can find them on our website, and we are rebuilding the website, by the way, Adams Financial Concepts. It should be live in a couple weeks again. You can sign up and like us on Facebook. You can sign up on Twitter. And right now, Sarah is is tweeting, not twittering. She's tweeting right now as we talk. You can ask questions on Twitter as well. She'll respond. We're coming to commercial break. Don't go away. Ezra has a lot more to say, and it's important to hear. Be right back.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on AdamsFinancialConcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
I'm here with Ezra Fain of Bridge Partners. We just got started, so why don't you give us a quick overview and then we'll drill down on a couple areas.
Okay, great. Thanks, Mike. So Bridge Partners is a business consulting firm. That means we help large corporations. We help them in identifying their strategies, refining those strategies, and then also implementing those strategies.
So let's drill down on some of the areas.
Sure, great. So we have what we call practice areas, and some of those practice areas are digital. So all things digital, digital transformation. We'll talk about that in a little bit. We have product and solution marketing. We have sales and channel. So how do you get your products to market and through which partner channels? We have people and change. So anytime you're going through a change, it's very important to understand how that impacts your organization and working through that. We also have an analytics practice. So everyone knows that big data and artificial intelligence are hot topics right now. We have a practice in those areas. And we also have a practice in business operations and technology advisory. So that would be more of like a program management office to help run a set of projects in your portfolio to make sure you're achieving the outcomes that you are set out to.
Okay, so let's drill down on the digital side.
Great. Yeah, so digital transformation is a fascinating topic. If you think about where we're at in terms of the era, we're in the digital age, the information age, and what is happening now is we have these three big trends that are really going to be transformational, and that's called digital transformation. What that means is we all have devices now, right? And that's called the intelligent edge. These devices are connected to the cloud, and the cloud is where all the data is stored. And then what you do with that data is part of big data and artificial intelligence. So the combination of those three is really what is transforming our society right now and our businesses as well.
And Bridge Partners, how do you deal with that with clients then?
So we help them to achieve these digital transformational goals. So imagine if we were going to be working with a communications company. Let's say it's a cell phone provider, right? So we know that a lot of the times before somebody walks into the brick and mortar store, they've already been shopping online. Shopping meaning understanding what products and services are out there. So they might look at what phones they're interested in, what the prices are, what the services are before they even walk into a store.
And so you help companies deal with that.
So we help them understand how they might optimize the customer experience when they walk into that store, knowing that they've already been looking online. How can we help them? Can we pick up from where they left off online? Meaning if they've already picked maybe a phone they want and saved it in their shopping cart, how does the sales rep in the store understand that what has happened and understand what their interests are and help them along that what we call customer journey more efficiently and seamlessly.
And it seems like with what's happening with retail business and even business to business, that is a more and more crucial factor.
Exactly. And so you'll hear people use the term multi-channel or even omni-channel. And what that means is maybe you're shopping online, maybe it's mobile with your phone, Maybe you're calling into a call center, or maybe you're in a retail store. And so having a seamless customer journey experience across all of those channels is really what omni-channel means. And digital transformation is helping to optimize that. And then when you tie in the big data and the analytics piece, you understand what the customers really, what their needs are.
So that's digital transformation, but that's not all that you do.
Right. So another thing that we were going to talk about is customer journeys. And traditionally in business, either if the customer is a consumer or an enterprise, you would have maybe some marketing activities, then some sales activities, then some service activities. And a lot of times those were a disjointed experience. And what you really want to do is look at the complete customer journey or the nurture journey and understand from awareness of the product or service to assessing the product or service versus different options to deciding to become a customer and then servicing that customer over time. It's a continuous journey. And you'll see there's a large industry trend now where many companies are reorienting towards this customer journeys. And it's a win for these customers. They're going to get the service they want, and it's a win for the businesses because they're helping their customers in a way that's smooth and efficient.
And when we talk about customer journey, this is a new term that's come up in the last few years. We're talking about the entire process from the time somebody becomes aware of a product until they purchase and beyond that to the service. That's
exactly right. And it's tying all those experiences together. And so there's a lot of work that is going on in these areas in terms of making sure all these systems are tied together. So if you're shopping online on your mobile phone and then you go into the brick and mortar store, and then you're also at that time very likely to continue to be shopping online and comparing prices, et cetera, while you come into the store. And then maybe once you already have your product, not offering you the same product again, right? Or if you're interested in a certain service or you've already acquired that service, not offering you something else.
And having the big data to understand what the difference is between Mike Adams and Ezra Fain are different buying patterns as well.
Exactly. And now with artificial intelligence, it will be interesting. So if you think about calling into a call center, nobody likes that experience, right? You sit on the phone for 20 minutes. I was on the phone for 20 minutes yesterday with my insurance company. And nobody wants to speak to robots. But if you call in and you're able to speak in a natural way and the program can help you get to where you want to be faster before you talk to somebody, that's a win for me instead of sitting on the phone for 20 minutes. And it's going to get me in the direction I want to go faster. And it's measurable activity from the customers so they can start to refine the way they interact with their customers.
So that's something that you help companies develop as well.
Right. So we will help them from looking at their strategy and then refining that, and then to helping them achieve these pieces as well.
So, and beyond that, you do several other things as well.
Sure. So another thing we do is help with competitive frameworks. And so a competitive framework is looking at what's happening in the market, what are you doing, what is your competition doing, and then based on what's happening in the market, developing strategies and then building plans from those strategies and then implementing those from a sales or marketing perspective. And then, I'd say just executing, running your business, and then measuring that, seeing how you're doing, and then assessing that performance, and then driving more of the behaviors that you want to see either through incentives or awards or driving this culture and with education and awareness. So it's a comprehensive business framework. And
that seems really important to me. When you look back at the history of what companies were, I've used the example sometimes of the bus companies. I hadn't seen buses on the road for a long time. They were the main form of transportation around the country. You had a few airlines, but not very much. Today, you hardly ever see the buses on the road. They've given that transportation away.
Yeah, so Uber is a great example of digital transformation. It's much easier now for you to use your mobile device. It understands where you're at, and it understands where you want to go, and then it has someone in a network who is close by and willing to take you on that route. And it's a much more friction-free experience. So you get where you want to go faster and actually for a more economical rate. And so this reduction in friction to getting you what you want, or saving you time, or saving you money, is going to become more and more popular. So there was a commercial on earlier about Alexa Music, right? And so being able to not even click a button to get what you want. So Amazon has an amazing business model where you can just speak into this device and it'll give you what you want. It'll be delivered in your door, maybe even the same day.
No, but there's so many industries which are going through changes and have to deal with those changes that if you don't deal with the changes, you'll find you're out of business. I mean, what you're doing is really crucial for a lot of businesses.
Yeah, if you look at Amazon's a great example. And if you look at market values for these retailers, if you look at it 10 years ago versus today, Amazon's put retail upside down, right? It's a completely different conversation now, right? And the power of brands is slowly reducing because people they don't have to trust the brand, they trust the society, the network. So you look at reviews of books as an easy example, right? To know which the best books are, you don't necessarily need to have a strong brand behind that, because you have the feedback from all the people who have read the books, right?
Yeah.
And it's the same in terms of going to a restaurant. You just look at how many stars that restaurant has on your mobile device while you're perusing around downtown.
So if someone wanted to get a hold of Bridge Partners and felt that they wanted to bring you in as a consultant, how would they contact?
Yeah, that's a great question. So anyone can email me at ezra.fain@bridgepartnersconsulting.com, or you can find us on our website at bridgepartnersconsulting.com. You can get a sense of the people that work at Bridge Partners. We're very experienced industry practitioners, so that means that we're not just consultants. We're also deep in these industries, so telecom, transportation, technology. And so we've got the experience, and then we have the consulting framework to put it all together and deliver the results that our customers are looking for.
So if you do need that, you know how to get a hold of Bridge Partners. We'll be right back after the commercial break. Don't go away. We want to talk about how a forger helped name America. That's coming right after the commercial break. Don't go away. We'll be back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So, how did a forger become involved in the naming of America? You know, Christopher Columbus sailed 1492. He sailed all the way to America, discovered the continent, sailed back, started some trade. We're going to be talking about trade. But we don't call the two continents North Columbia and South Columbia. We call it North America and South America. How did that happen? Well, the fact is that Columbus never believed that he had discovered a new continent. He believed that he had sailed all the way to Asia and back again. and then back to Asia and back again. But 5 years, in 1497, there was a navigator, a sailor from Florence, Amerigo Vespucci, who repeated the feat of sailing to the New World, but he sailed to South America instead. He realized, however, that he had reached a new continent. This was not Asia, and he declared for the first time that he had reached a new land. But he never intended to get the New World named after him. He just wanted to let people know there was a new world. But there was a forger who wanted to make a quick buck, who wanted to con people, and so he began to fabricate letters purporting to be Amerigo Vespucci. He claimed to be, and wrote these home, and made up stories about the New World. And that's when a map maker, Martin Waldesmüller, making a map, making a new atlas, wrote in the margin of his atlas a new name, Amerigo. And from that, it became America, all because of one forger who wanted to make a couple bucks off some letters that he forged. But that was not really the beginning of globalization, but it was the beginning of trade with the New World. And it seems that begins to play into what we're doing today. I've been talking now for almost a decade about the supercycle. We live in what's called a supercycle. UK Bank, Standard Chartered Bank, did a study that became very popularized around 2009, 2010, talking about supercycles when the world GDP grows at a faster rate. If you've been listening to the program, you've heard me talk about this enough, so you might be tired. But it is something that, from a 1 mile high view, really factors in. From 1870 to 1913 was the first supercycle. It was driven primarily by the industrialization of the United States. From 1945 to 1970, the second supercycle, when world GDP grew at a faster rate than average, driven by the rebuilding of Europe, by the decolonization of a lot of the world. In the U.S., we were building highways, we were building airports, we were going through the return of the GIs and all the expenditures that came, the innovation, the technology, all those things going on. That was the second supercycle. Standard Chartered Bank said in 2009 there was the beginning of a new supercycle, which will be driven by the emerging nations. They're going to drive the supercycle. When you look at it, by 2030, the forecast is that 93% of the world's middle class will live in those emerging nations. 93%. They're consumers, moving from subsistence to actually consuming. That's the overlay to the whole thing. And so as we begin to talk about what's going on in terms of the negotiations over NAFTA, over TPP, we're talking about free trade. And when you begin to have trade between countries, international globalization, without free trade, you end up with trade restrictions by countries. In the name of protecting their home industries, in the name of making their own countries great again, in those terms. And the result is it limits the number of choices, because a lot of things will not be exported, or if they're exported, they'll be exported at much higher prices or with much greater tariffs. And the brunt of that is borne by the lower classes in those countries. Free trade gives access to higher quality and lower priced products. There's more growth because there's more exports. It improves efficiency and innovation, it improves competitiveness, and it improves the fairness of what's going on. If you look right now, we're in the process of renegotiating NAFTA, something that's been called the worst trade deal ever made. If it is, maybe, maybe not. It's between Canada, Mexico, and the United States. And some parts are moving along nicely. But there's been a number of issues that have been raised that have caused a lot of pushback. The U.S. has asked for anti-dumping regulations on the agricultural products from Canada, dairy, eggs, and poultry, and that's caused an outrage from our Canadian partners. We propose scrapping the Article 9 of NAFTA, which is how you resolve disputes. And before we had that, in 1987, we were talking trade, and the Canadians walked out of trade over that very issue. But even beyond that, there's two issues that came up in the last meeting. 22 days, 4 different meetings, but the last meeting we had, there were 2 big issues, 2 significant issues. They've been called so extreme as there's no allowance for negotiation. The first was the demand for a 5-year sunset clause, which meant every 5 years NAFTA would come to a close and would have to be renegotiated. The issue with that from the trade partners is what company is going to do any cross-border investment if they don't know where they're going to be in 2 years. That's a big issue. The second issue is the car industry. A quarter of American imports from Mexico and Canada have to do with cars. And right now, NAFTA says that 62.5% of the car parts have to be generated in those 3 countries, Mexico, the U.S., and Canada. The U.S. proposal is that be 85% and at least 50% from the U.S. The response to that will probably be that will not be an agreement, that rather pay the 2.5% tariff, which will raise prices to Americans. It will not create jobs in the U.S. It'll lose jobs in the U.S. And those are 2 issues which, presented at the last meeting, are very onerous for the whole thing. Canada and Mexico are thinking of what to do if NAFTA fails. It's going to have a significant impact on the U.S. Already in Iowa, we send grain to Mexico. Argentina has already stepped up and said, we'll supply that. So there's big issues to come. The Trans-Pacific Partnership, we withdrew. We were the leadership in that. We withdrew. Guess who's stepping in to replace us? 5 letters called CHINA. China is ready to replace the U.S. Those things can have a significant impact. Portfolios have to be built with that in mind. And with that wrapped up, I will wish you a very happy Thanksgiving. If you do happen to listen on Thanksgiving, it'll be a special program. Like, how did we get White Christmas? That's coming on Thanksgiving Day, so tune in, and I will be back in 2 weeks. Talk to you then. Bye-bye.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's Adams Financial